When most people look at the stock market, they do not really see businesses. They see moving numbers. They see green days and red days. They see fear, excitement, opinions, predictions, and 1,000 men on the internet pretending they know what tomorrow will bring. That is why so many people stay confused. They are staring at the scoreboard before they understand the game. If you do not understand what a company actually is, the market will always look more mysterious than it really is. But once you understand what a company is and what a stock is and what a bond is and why prices move, a great deal of the fog disappears. You may still not predict the market. I certainly would not recommend trying, but you will understand what you are looking at, and understanding what you are looking at is the beginning of behaving rationally. I have spent most of my life around businesses, balance sheets, market prices, managers, capital allocation, and all the human emotion that attaches itself to money. The older I get, the less impressed I become by people who speak about stocks as if they were lottery tickets with ticker symbols. A stock is not a lottery ticket. It is not a flashing line on a phone screen. It is not something magical that belongs only to Wall Street people in expensive suits. A stock is ownership. That sounds simple because it is simple. The trouble is that simple truths are often buried under too much noise. So I want to walk through this the way I would explain it to someone who has never taken a finance class, never cared for market jargon, and only wants to understand what is really happening when people say they own stocks, bonds, businesses, and index funds. The first thing to understand is what a company is. A company is a basket. That is the cleanest way to think about it. Inside that basket are all kinds of valuable things. Some of those things are easy to see: buildings, trucks, tools, computers, factories, inventory, real estate, physical equipment. Other things inside the basket are harder to see and sometimes more valuable. A name people trust, a reputation people remember, a customer base that keeps coming back, a distribution network, software, a formula, a process, a brand that lets the company charge more than a weaker rival could ever get away with charging. This is why two businesses can sell objects that look similar and still be worlds apart economically. Take a company like Apple. Yes, Apple has buildings. Yes, it has offices, stores, equipment, and supply chain relationships. But if you think the real treasure in that basket is only the inventory stacked in a warehouse, then you are looking at the business like a child looking at a watch and seeing only the metal. The true power is deeper. The name, the trust, the habit, the ecosystem, the fact that millions of people will pay more, wait longer, and defend the choice emotionally because the company has built something in their minds that is far more durable than the physical object itself. That is what a company is. A basket of valuable things, some visible, some invisible, some easy to count, some very hard to measure. Once you understand that, the next question becomes obvious. Who owns the basket? That is where stocks and bonds enter the story. The easiest way to understand the difference is not through formulas. It is through a small business. Imagine you are a carpenter. You have skill, you know how to work, you know how to make money once the tools and vehicle exist, but skill alone is not enough to start the business. You need a truck, you need tools, you need working capital, you need enough money to begin. Suppose you have saved $10,000. That is something. It is not enough. So you go to your friend Jake and borrow another $10,000 at 5% interest. Now you have $20,000, you buy the truck, you buy the tools, you begin taking jobs. A year later, the business works beautifully. You made $50,000 in profit, and you still own the truck and the tools. Now comes the important question: how is the money divided? Jake lent you money. He did not buy part of the basket. He is entitled to what was promised, his $10,000 back. Plus the agreed interest, that is all. He has a prior claim, but not an unlimited one. After you repay Jake, whatever is left belongs to you because you are the owner, Jake. In financial language, is acting like a bondholder. You are acting like the stockholder. That is the core distinction. A bond is a contract. Give me your money and I will return it with interest. The upside is limited. The risk is generally lower if the borrower is strong. A stock is ownership. Give me your money and you own a piece of the basket. The upside is potentially very large. The risk is also much larger because if the basket shrinks badly enough, The owner is the one who gets hurt last and hardest. This is where people begin seeing the beauty and the cruelty of the system. If the carpenter's business succeeds, the owner keeps the rich upside after the lender is paid. If the business fails, the lender still wants to be repaid first, and the owner may get nothing at all. That is not unfair. That is, the bargain bondholders get paid first, but they only receive what was promised. Stockholders get paid last, but what remains belongs to them. That rule is one of the deepest truths in all of finance. It never really changes, and once you understand that rule, a great many other things become easier to grasp. Now imagine the business grows. The carpenter does well. One truck becomes two. One neighborhood becomes several towns. Then several towns become several cities. Growth needs cash. A business can borrow more, yes, but debt is not free. Debt increases pressure. Debt creates fixed obligations. Debt can be wonderful when used carefully, but too much of it can break even a promising company. So instead of borrowing everything, the owner decides to sell pieces of the basket Maria buys in. Then Tom, then other investors. The money they contribute goes into the company and helps it expand. That event, in the broad sense, is what the public market is built upon. An initial public offering, or IPO, is simply the first time the company sells pieces of itself broadly to the public. This part is important because many beginners misunderstand what comes next. When a company first sells shares, the company gets paid, that is, new money coming into the basket. But after that, when one investor sells to another investor, the company usually does not see that money at all. The company was paid at the creation moment. After that, the pieces of ownership are simply traded, that is, the stock market. It is not usually money flowing into companies every day. It is ownership changing hands between investors. If Maria wants out, she sells her shares to someone else. That person pays Maria. The company does not get that money. The company is not standing there at the cash register every time a share changes owners. The easiest analogy is a used car. Toyota gets paid when the new car is first sold. After that, the used car may pass between 5 different owners over 10 years. Toyota does not keep collecting a check every time that car changes hands. The stock market works the same way. Once the shares are out there, investors trade them with each other. That is why the market is so active and so emotional. Trillions of dollars change hands, not because companies are constantly reissuing themselves, but because millions of people keep deciding what those baskets of value are worth. Now, the next question naturally appears: if the company usually does not get paid when shares are traded, why own the stock at all? There are only a few honest answers. First, the value of the basket may rise. If you buy ownership when the market says that slice is worth $50 and later the market says it is worth $100, you have doubled your money. Second, some businesses share cash directly with owners. Those are dividends. If a company earns more cash than it needs and the people running it decide they cannot reinvest all of it at wonderful returns, they may send some of that excess cash to shareholders. Own 100 shares and get paid $2 per share, and $200 lands in your account. That is not magic. It is ownership receiving its share of the excess. Some companies do this regularly. Others almost never do it because they believe they can use that cash more profitably inside the business. Neither choice is automatically better. It depends on the quality of the reinvestment. That is one of the first places where real investing begins. Not with slogans about dividends or growth, with judgment about whether management can turn retained capital into higher future value. But regardless of whether the reward comes through dividends or through rising share prices, the principle is still the same. You own part of the basket. If the basket becomes more valuable or throws off cash, you participate. That is the point of stock ownership. Now, once people understand what they own, they almost always ask the next question: why do stock prices move so much? The answer is not mysterious. Supply and demand. That is all. More buyers than sellers. The price rises. More sellers than buyers, the price falls. That sounds too simple because people want a more dramatic story. But the simple story is the right one. The market price is whatever the next buyer and seller agree it should be right now. Of course, the harder question is why those people are eager to buy or sell in the first place. That is where the future enters. Stocks are not priced based only on what the company did yesterday. They are priced based on what people believe the company will do tomorrow. That is why headlines move markets. A company reports great earnings and people start imagining better years ahead. They buy, the price goes up. A company warns about weak demand, shrinking margins, a lawsuit, regulatory trouble, or some strategic mistake. People sell, the price falls. Sometimes these reactions are sensible. Sometimes they are wildly emotional. Sometimes millions of people get greedy or frightened together. That is why I have long said the market is partly a voting machine in the short run and more of a weighing machine in the long run. In the short run, emotion, attention, fear, and excitement can move prices far away from what sober business judgment would recommend. In the long run, the economics of the company do the heavy lifting. If the business truly becomes more valuable, the stock eventually has a way of reflecting it. If the business decays, no quantity of slogans can protect the owner forever. This is why understanding the basket matters so much. The public is forever trying to understand the moving price. I would rather understand the thing the price is attached to. The thing is slower, more rational, and more real. If you know what the basket contains, you become much calmer when the people around you are reacting to the flashing numbers. Now let me go deeper into something that confuses beginners. They often think that if prices are set by supply and demand, then prices must be random. Not at all. Supply and demand may set the immediate price, but expectations shape the demand. And expectations are built on business realities, interest rates, economic conditions, management behavior, industry structure, customer demand, regulation, innovation, and 1,000 other variables. That is why stocks can feel complicated. Not because the core idea is complicated, the core idea is ownership. The complication comes from the fact that the future is uncertain. A stock can go up because the business truly improved. A stock can go up because people merely think it improved. A stock can go down even when the business is still decent if expectations were too high. A stock can rise even on bad news if the news was less bad than investors feared. That is why treating the market like a machine that always behaves sensibly in the moment is a mistake. The market is made of people. People are often intelligent. People are also often emotional. That combination creates noise. Now, what should an ordinary person actually do with all this information? This is the point where many people expect some clever answer. They think once the mechanics are understood, the correct next step must be stock picking. Find the winner, beat the market, spot the hidden gem, outsmart the crowd. I have never found that line of thinking especially attractive for the average person. Why? Because most people do not need more excitement. They need a structure that works even if they are not brilliant. The source document reaches the same conclusion. It says that most professionals do not beat the market consistently, and that ordinary investors should not assume they will either. It recommends index funds, especially broad funds tied to the S&P 500, as the simplest way to own many businesses at once. It notes that the S&P 500 represents the 500 biggest companies in America and says that over the last century it has averaged about 10% annually, though of course with some years down and some years very strong. The point is not smoothness. The point is long-run upward progress. If you hold patiently, Fay Felicite Fay turn 82, file 0 Fay, that advice is not glamorous. Good glamour is one of the most expensive things in all of investing. An index fund is just another basket. But now the basket contains many smaller baskets. You buy once and own slices of Apple, Amazon, Google, Coca-Cola, banks, industrial firms, healthcare companies, retailers, and on and on. You are no longer trying to guess which one company will dominate. You are buying a broad, productive system that changes the emotional problem entirely. You stop needing to be right about every individual story. You only need the broader engine of business and human progress to keep functioning over long periods. That is a much easier bet than trying to outsmart the entire market stock by stock. Now, people complain that this is boring. They are right. It is boring. That is part of the beauty. The best long-term wealth strategies are often psychologically unsatisfying in the short run because they do not provide much entertainment. They ask you to keep buying, keep waiting, and keep refusing to let daily emotion change your long-term plan. That is hard for many people precisely because it is not exciting. But excitement is rarely what builds durable wealth. Consistency does. If you buy a broad index fund regularly, if you keep costs low, and if you do not panic every time the market reminds you that ownership is volatile, then time becomes your ally. That is the real miracle in finance, not cleverness. Time working on top of discipline, time working on top of patience, time working on top of broad ownership rather than scattered impulsive guesses. This is why I have always liked structures that require less forecasting and more staying power. The average investor does not lose because he lacked the IQ to understand a balance sheet. He loses because he panicked, speculated, chased, bragged, sold low, bought high, or insisted on making the whole experience more dramatic than it needed to be. An index fund is an answer to human weakness as much as it is an answer to financial complexity. It protects people from their own urge to be clever. That matters a great deal. Now, let me recap the logic in plain language, because I think ordinary people deserve plain language. A company is a basket of valuable things, some physical, some intangible, some obvious, some almost invisible stocks, and bonds are simply two different claims on that basket. Bondholders lend money and get repaid first, but only what was promised. Stockholders own what is left after everyone else is paid. When a company first sells shares, it gets the cash. After that, shares mostly trade between investors. That is, the stock market prices move because of supply and demand. But demand is driven by expectations about the future. You make money as a shareholder in only a few honest ways. The stock goes up because the basket becomes more valuable or is expected to. The company pays dividends or both. And if you do not want to spend your life guessing which individual basket will perform best, you can buy a larger basket that owns many businesses at once. That is what an index fund is. Now I want to say something else because I think it is where people finally either grow up financially or stay children forever. Once you understand that a stock is ownership, you stop asking the wrong questions. You stop asking, what did the stock do today? You start asking, what does the business do and what might it become? You stop asking, can I get rich fast? You start asking, can I own productive assets for a long enough time that their economics help me? You stop talking about trading as though it were the same thing as investing. They are not the same. One is often a reaction to price, the other is a response to business value. And once you really understand that difference, the whole market becomes quieter, not because prices stop moving, because you stop moving with them emotionally. That is when real progress begins. The stock market is not meant to be a machine for keeping you entertained. It is a machine that allows ownership to change hands. That is all. People have built an entire industry around making that machine seem more mysterious, more urgent, and more dramatic than it really is. I have no interest in that industry. I am interested in the simple truth underneath it. Own good businesses or own many businesses through a broad fund. Be patient. Understand what claim you actually have. Respect the difference between lending and owning. Respect the difference between price and value. And do not confuse daily movement with real progress. If an ordinary person can learn those few lessons early, he has already done better than many people who spend decades around money and never understand what they actually own. That is why I say once you understand what a company is, the rest of the market finally begins making sense. Not because you become a prophet, because you stop being confused. And in finance, stopping confusion is one of the highest returning decisions you can ever make. There's one more reason this way of thinking matters, and it has very little to do with markets and a great deal to do with temperament. Once a person understands that a stock is a business claim, he stops behaving like a permanent customer of urgency. He no longer needs every market move to mean something about him. He no longer feels compelled to do something simply because prices moved without asking permission. This is one of the biggest hidden advantages of real understanding. It reduces unnecessary motion. And unnecessary motion is one of the most expensive habits in all of investing. People are forever trying to improve outcomes by increasing activity. Trade more, check more, react faster, watch more videos. Read more predictions, switch funds, trim this, add that, get out, get back in. Very often what they are really doing is converting uncertainty into motion, because motion feels emotionally cleaner than patience. Patience feels like doing nothing. Motion feels like taking control. The trouble is that markets do not pay you for feeling in control. They pay you for being right. And over long periods, they often pay ordinary people best when those ordinary people stop trying to outdance a machine built to punish emotional overreaction. That is why broad ownership matters so much. It gives a person permission to act like an owner rather than a guesser. An owner can wait. An owner can think in years. An owner can let business results matter more than mood. A guesser is trapped in the opposite condition. He needs noise, he needs movement, he needs prediction, he needs to feel clever, and because he needs all of those things, he often becomes the ideal customer for the financial entertainment industry. That industry is massive because confusion is profitable. Confused people click more, they trade more, they worry more, they ask for more forecasts, they are easier to sell new narratives to because they never really built a simple framework strong enough to quiet the nonsense. That is why I think basic understanding is one of the highest forms of financial self-defense. Not because it turns you into a genius, because it turns you into someone much harder to manipulate. You stop being impressed by the wrong things. You stop being frightened by every ordinary correction. You stop believing that owning businesses should feel smooth every week. You stop asking the market to entertain you. And once you stop asking the market for entertainment, it becomes much easier to let it help you build wealth. That is the final lesson. Understanding does not eliminate uncertainty. It eliminates unnecessary confusion. And for most people, that alone is enough to change their whole financial life.